Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. So far this year, the S&P 500 is up nearly 15%, thanks mostly to 8 technology stocks. This has put stock investors in a difficult position. If you didn't already own tech companies, should you be buying them now? And what about the other sectors that have had more mediocre performance this year? Are they worth buying today? It's especially important right now to focus on only buying a stock when you think it's trading at a significant discount to what you believe that stock is worth. That large discount to fair value is what's called a margin of safety. It's also valuable to only be buying in a disciplined manner today because of the activity by central banks, total market valuations, and the direction of employment. In the financial media, you'll hear a lot of discussion about what central banks around the world should be doing in regards to their interest rate policy. We don't think it's all that important to be discussing about what they should be doing, though. What's valuable is thinking about what they will be doing. And what the major central banks have signaled they will do is continue to increase interest rates, because core inflation is still sitting at 4 to 7% in the major developed markets around the world. That's too high, and it's going to continue to act as a headwind on the economy. In the United States, core inflation is not close to a level that the Federal Reserve has signaled that they would start to ease on the restrictions they're trying to put in terms of monetary policy. The Federal Reserve Chairman has said he will not stop with monetary tightening until the core PCE inflation is below every Treasury yield from 3 months to 30 years. From projections we've studied, core PCE will stay above 4% for the rest of 2023, so don't expect a shift in policy until at least next year. We doubt the Federal Reserve is too concerned about being too restrictive with its monetary policy when the price-to-earnings ratio of the S&P 500 is nearly 20% above the average of the last 20 years. And it's hard as an investor to justify aggressive buying of stocks when the starting valuation is 19 times earnings. We've discussed jobless claims data in the past. This time we want to look at jobs and employment from a different perspective. Investors are forward-looking. If they see weakness on the horizon within an industry, they will start selling the shares of those companies before the data hits. We can get a read on how investors view the job landscape based on the stock performance of staffing companies. This is because before companies begin laying off their employees, they first adjust by pulling back on hiring. Robert Half International is one of the top staffing businesses in the world. What's interesting to us is before the last 2 recessions, its share price peaked 18 months before the peak in the S&P 500. Its underperformance in those periods before the stock market decline began was 45%. If we look today, it's underperformed in a similar manner over the past 16 months. Not a good sign for employment in the future. Here's the year-to-date performance of the stock market split across some of the major sectors. The returns in technology have been stellar. The rest of the market has been mediocre. So what should a stock investor do now across these sectors? Let's start with the top performing sectors this year: technology and communication services. If you owned some stocks in these sectors last year and have benefited from the rise this year, that's great. You can hold your winners or perhaps trim the positions a bit. But we would not add to tech at these prices. Most are trading above fair value and are likely to pull back at some point. Next, we would avoid adding to traditional cyclical sectors at these prices. Energy, financials, and retailers may have declined in recent months, but they have not reached the margin of safety we would want before buying. So where does that leave us? Defensive sectors. We still only want to buy stocks in those sectors that we believe are undervalued, but we expect these sectors to hold up best until the next buying opportunity in the cyclical areas. Let's look at valuations on an industry level within sectors. This shows Oxbow's average valuation across stocks within industries in the tech, industrials, energy, and healthcare and utilities sectors. If a bar is above 0%, it means the average stock in that industry is trading above our fair value estimate and is overpriced. If it's below 0%, the average stock in the industry is below our fair value estimate and is underpriced. We never want to overpay. After the big rise in share prices for tech, most stocks in those industries are overvalued. Industrials haven't been great performers so far this year, but they also haven't pulled back by much, so there's not much to buy there. Energy has declined about 15% from its peak, but it's a volatile sector. We want a deeper discount to fair value before adding any of those positions. That's why we only own pipelines in our high income strategy. They're more discounted than the rest of the sector and also the most stable industry within energy. That leaves us with some of the defensive industries such as pharmaceutical, health insurers, and utilities that intrigue us the most right now. They're the cheapest of the industries that we're currently following and also some of the least volatile in business performance and share price fluctuation. Thinking about premium or discount to fair value is a good first step. The next step is considering how much of a discount to fair value is necessary before buying in order to limit downside on the positions we own. We want to minimize the odds of a 20% discount in any of our positions. That's especially important for cyclical sectors with volatile stock prices like technology, industrials, and energy. Stocks in these sectors can trade 30 to 40% above fair value and then trade 30 to 40% below fair value. As a result, we typically want at least a 20% discount and more likely a 30% discount to fair value before we would look to buy. Because many of these industries are trading at or above fair value today, they are a long decline away from meriting consideration as new buys in our stock portfolios. However, in the defensive industries, the discount to fair value doesn't have to be as large, maybe 15 to 20% from fair value, because their cash flow generation is more stable and their stock prices are less volatile. That's why they're closer to being buys for us at today's prices. We hope that gives you a sense of how we assess the attractiveness of individual sectors and wait for the right margin of safety before buying. We want to generate a solid return through a full economic cycle, and one of the requirements of doing that is thinking about the potential downside of every stock we analyze. Then we can patiently wait for the price we want to pay rather than chasing stocks higher. If you'd like to learn more about our process at Oxbow, please contact us. We like to provide the information we think is most valuable for investors. If you'd like to see more videos like this, please subscribe to our YouTube channel.